Hello and welcome, everyone. I'm Ryan Heckman, the CEO of Rallyday Partners, and this is the Founders Journey podcast. We'll explore the heart and soul of great founders and their journey to build the company of their dreams. You will learn about new industries and business models while discovering how to apply the founder's mindset to your everyday work and life. Welcome to another episode of the Founders Journey podcast. I'm your host, Ryan Heckman, and I'm joined today by Jacob Manoukian. I'm going to let Jake give you a little bit more about his background. But before we do that, we wanted to set the table. As it was in COVID, I found myself and have been finding myself almost mesmerized and addicted to the news feed that's coming out of either Bloomberg or Financial Times or Wall Street Journal. And I have not found that to be particularly productive. And during COVID, I learned to stop watching the news and start calling really smart people to help me get a more informed view of the state of play and what I should be doing about it relative to my business. And so I found myself doing that again. And I had an idea about a week ago to record those conversations in service to other founders and business leaders out there that could benefit from those conversations firsthand. And so therefore, this is a special edition of the Founders Journey podcast. I called my good friends at JP Morgan and I said, who is the best person at JP Morgan to kick this off, with the notion of doing maybe 45 minutes on the Wall Street side of this, which we'll do in this episode. We're going to do 45 minutes after this on the Main Street version of this by seeking the counsel and views of an expert in supply chain for private equity-backed portfolio companies, nationally renowned practitioner named Tim Van Meegen. And then thirdly, your street and your own reaction to this crisis, if we want to call it that, with the assistance of a performance management consultant named Brian Kite, who we've worked at extensively at Rallyday. That session is going to be all about whether it's this crisis or another. As a leader, what's the right balance between learning and reacting versus responding strategically to what we're confronting in service to better outcomes and how we handle ourselves in crises like this. So that's sort of the three-stage rocket. I am really honored that Jake raised his hand and said, yeah, I'm all in. Let's help the Rallyday community make the most of this situation. And Jake, I just want to thank you for being such an enthusiastic contributor to this, what I think is very important work.
Well, thank you. And thanks for having me. Thanks for reaching out. I'm glad we made the connection, and it's going to be a fun conversation. Well, as fun as it can be, at least.
Right. Sort of humor in the face of crises like this is probably good at times. But Jake, if it's okay, tell us about how you got to the most powerful financial institution in the world, if not in the history of the world, and how you became you at the firm and what you've been up to the last, let's say, 2 or 3 months.
Yeah, it's always good to start with some personal history before we get into the history of global trade, I suppose. But I've been at JP Morgan for almost 15 years now. You know, when I got to JP Morgan, what I realized that I kind of connected most with and was most curious about was connecting these kind of big current event episodes that influence the macroeconomy, influence the markets, and connecting those into like what actually matters for our clients, who are largely long-term investors, who have goals for themselves, goals for their families, goals for their philanthropic needs, and really just putting the kind of day-to-day, week-to-week, month-to-month macroeconomic events of the day in the context of what it means for them. And I've sat in a lot of really interesting seats while I've been at JP Morgan. One of them was working for Michael Sembalist, who's our chairman of market and investment strategy. He's made some press recently for some of his commentary around tariffs and trade. He's really an institution within Wall Street, and he's a very differentiated thinker. And that was a very formative experience for me in terms of just learning how to think about the world, learning which sources to pay attention to, which sources to discount, and then how to kind of aggregate all of that information and synthesize it into your own view and then into the firm's view. So I've been in my current role, I'm really focused on helping families in the United States think through their financial plans in terms of what JP Morgan's view of the world is, not only for the next week or month or 6 months, but for the next 10 or 15 years. So that's a little bit of a professional biography. Maybe we can talk about our shared history as being competitive skiers. I was a downhill skier growing up, not a biathlon or cross country athlete, but maybe we can do that at the end.
Well, I'm not going to allow you to accuse me of just being a cross country skier, Jake. I was a Nordic combined skier, which has the common.
There you go. Excuse me.
The cooler version of that world, ski jumping, and the more boring part, cross country ski racing. But we share in that background, which is super cool. Did you grow up in New England and trained?
Well, no, I grew up in Lake Tahoe.
Oh, wow.
So I grew up on the soft snow. And then I went to high school at Holderness School in New Hampshire, which has a great winter sports program, and ski raced for Holderness. I actually ski jumped once.
Which hill?
At Proctor. I don't know if you know Proctor, but they have a little.
I've never ski jumped at Proctor, but
there you go. Well, I don't think it's Olympic size, but I did manage to successfully ski jump.
Fantastic. Well, briefly talk about your domain at JP Morgan today. And I want to encourage you to flex just a little bit. I mean, you're a force at the firm. Maybe talk to us a little bit about that without totally bragging on yourself.
Well, I mean, first of all, it's a team, right? And the best part about my job is I have access to all of the smartest minds at JP Morgan, whether those are economists, portfolio managers, traders, advisors who are actually in the field talking to clients on a day-to-day basis. And I also have access to our global client base. And, our clients are business owners and they're CEOs and they're kind of influential people in the community. And I learn more from, sitting in meetings with our clients than I do from sitting in front of the computer screen reading Wall Street research sometimes. So, I'm just lucky to be in a position where I get access to all these amazing minds and all these amazing thoughts. And I just get to collect all of that into a clear, consistent narrative around the world. And another amazing part of being at JP Morgan is there's counterparts that I have in London, in Hong Kong, in Latin America. So we get a real global perspective on what is, oftentimes we have a kind of myopic focus on a US perspective. But working at JP Morgan kind of makes you have a global perspective on all of this. But maybe the way our work kind of manifests itself is through mid-year and annual outlook pieces. We're working on our mid-year outlook right now. It's probably one of the hardest ones that I've ever worked on, just because of the volatility that we've seen in markets, and it's really hard to get a handle of a kind of consistent trend or a consistent view to kind of use as a framework or a toehold. Which is what you were alluding to at the beginning. And then, we also have weekly and monthly publications for the folks that want to follow markets on a little bit more timely basis. So we're just trying to meet clients where they are in terms of their interest in markets and their interest in investments. But I couldn't be more thankful to work at a place where I have access to such amazing thought leaders. And I just get to aggregate it all and hopefully elevate it into a way that makes an impact.
Well, why don't we compare and contrast COVID to the tariff situation? And that may be a stretch, but I don't know about our listeners or you, but I found myself as recently as a week ago tempted to go to Target and buy a bunch of toilet paper, for example, which I was like, wow, that's so wild. And I've since had conversations with other people comparing these two crises in terms of the cascading worldwide impact of them, and just how interesting that is to compare these two crises to one another. From your perspective, how would you compare and contrast the significance? Let's not talk about the health ramifications or whatever, which we should never forget, but as it relates to the world order and the socioeconomic effects, how would you compare COVID to tariffs and the extent to which they have impacted the way we are going to roll in the future?
Yeah, I mean, this is a really fascinating way to start. There are a lot of parallels inside of markets between this kind of tariff rollout and the initial stages of COVID. The eerie thing is the peak of the market before COVID was, around February 20th, 2020. And the peak of the market this time around was February 20th, 2025. So it's almost 5 years later, you have this kind of mirror image where the market starts to sniff out that something is amiss.
Sorry to interrupt you, but never mind the fact that at least here in Colorado, COVID resulted in kind of government mandated shutdowns. I think it was on March 17th. And I believe that quote unquote Liberation Day was on like the 23rd of March, like, which is wild, right?
Yeah, I think Liberation Day was April 2nd.
Okay, pardon me.
But the funny thing about the market reaction is that the COVID bottom was actually faster than the bottom from kind of Liberation Day. So if the current bottom holds. So I think, on the morning of April 7th, the S&P 500 kind of touched that 4,800 level kind of for a couple minutes there. And that was the low. But, during COVID, the market's bottom March 23rd. So you had a steeper, faster drawdown. And the reason the markets reversed course is because there was a policy response. And what happened is the Federal Reserve pulled out the kind of monetary stimulus bazooka to settle down the bond markets and make sure that financial conditions, and we can talk more about that. I'll make sure to explain the importance of that a little bit later. And then Congress passed the CARES Act, which was the first round of the COVID stimulus bill that included things like the payroll protection program and the stimulus checks and augmented unemployment insurance. So because Congress and the Federal Reserve acted so quickly and so forcefully, markets could bottom really quickly. And of course, it wasn't a straight line, but markets basically went up and to the right from that moment until the end of 2021. But just because stock markets were going up and to the right doesn't mean that the economy was working properly. When you think about COVID, one of the lasting legacies is that it kind of altered the way we think about economic cycles. And it did that because you broke the correlation between different sectors and industries. If you think about what happened during COVID, everyone was locked at home. Instead of going to the theme park or on the cruise, you were buying a new grill or a new cooler, or doing a kind of a renovation of your basement. That led to a surge in goods demand and household durable demand. Then when the world reopened, all of that spending shifted from household durables to services and led to a lot of shortages and issues in the services space. And all of that together, the stimulus checks, I don't even know if this is a word, but like the lack of syncopation within the economy led to an inflation issue. Now, one of the key reasons why this tariff episode is similar to COVID is we would describe it as an event-driven episode of volatility. And what we mean by event-driven is there's an exogenous shock that makes market participants question the price that they're paying for certain assets and makes them rethink the outlook that they had or the prevailing wisdom that they had coming into the event. So COVID, that's obvious. There's a pandemic. It's an act of God. It comes out of nowhere. There's a lot of different permutations for how this could go. There was a clear bear case there where the government didn't respond forcefully enough. And you have 20 million people get laid off in March and April of 2020, and it causes a real economic spiral. The policy response was there, though. The markets this time are behaving in a really similar way in that they're waiting for a policy response because we'll probably get into this later in the conversation. You can debate the pros and cons of tariffs from kind of like a geopolitical perspective, but I don't think there's much debate around the idea that tariffs are a tax on businesses and consumers. And tariffs in and of themselves are kind of antithetical to the way that the S&P 500 has designed their business models. So when you come out and you say, okay, we're going to raise the tax rate by 2% of GDP, which is what this tariff proposal as written was effectively doing, the stock market should probably be worth 15 or 20% less than it was the day before, which is essentially what happened. And what you saw in the last couple of weeks is when volatility reaches a certain point, policymakers, and for the time being, that's been from the White House, have responded. And they've responded by kind of watering down the tariff proposals, delaying the tariff implementation, excluding certain goods. Even at time of recording, the markets are rallying because there's a sense that the White House and the administration want to make a deal with China. So there's a similar pattern there where markets are going to bottom when policymakers start to pivot and policymakers start to respond. And we've started to see more and more of that lately. But happy to talk about maybe the way that we're seeing some of the economic implications and drawing out some similarities and differences between the COVID period too.
Yeah, let's level set on what the goals the tariff policy are and maybe get your views on force ranking desired outcomes in these. And at the risk of sounding maybe a tish critical, which I don't want to, this is not a policy discussion per se, but I think we need to start with what are we trying to accomplish? And I read one writer, and I think it was in Bloomberg, who said it felt like four horses pulling a carriage in opposite directions. And they went on to explain that there appears to be opposing goals here. And, one of them is reshoring, which I think we all understand what that looks like. And it's an attempt to become a bigger leader in manufacturing and so forth. That's a desired outcome. A second one, perhaps, is to increase tax revenue in a manner that will provide for tax cuts elsewhere. A third one could be to, in some ways, isolate China for geopolitical reasons and tilt some of the accelerating growth from that region back to the United States, and therefore get an upper hand in other facets to the competitive nature of that relationship. And maybe a distant goal that I've heard, at least as it relates to some recent negotiations with the UK, is to use tariffs as a means of extracting political influence through economic measures and maybe even cultural influence, like was suggested by Vice President Vance when he suggested that the UK should consider changing their DEI policies in return for tariff relief. So it's a lot, and it's really ambitious, you could say. How do you look at that, Jake? How do you parse out what's real and what's not, what's meant for political gain versus actual gain? If one of your kids were to say, "Hey, Dad, why are we doing this?" what would be an answer that you would give with a straight face?
Yeah. And so I'll just start this by saying this is one of the reasons why the market's seen so much volatility, because there's a huge debate within Wall Street about what the real point is. And there's some, if the negotiating tactic theory is actually right, that's very bullish, because it means that, this is all just a big ploy to get a lot of concessions and then we'll go back to the way it was. But if the real goal is to raise taxes, that's relatively bearish, because it means that corporate taxes are going up and consumers are going to face higher prices. The way I'd answer it with a straight face is I think there's a lot of kernels of policy positions that are very credible within the rhetoric. When you think about national security, like that's a big one. There's a really strong case to be made that the US industrial base has kind of been isolated from the rest of the economy, and that industries that are critical to national security, healthcare, defense, high-tech weaponry, energy supply chains, night vision goggles, like
chips.
However.
How about chips?
Chips, I haven't even mentioned it yet, right? Like, are globalized, and in the event of a national emergency, or in the event of a war, we would face a lot of problems sourcing those components and those products domestically. Okay, got it. I think a goal that all of us could agree is worthy of pursuit. Raising taxes and dealing with the deficit. There's varying perspectives on this. I think no one will get in trouble for saying that we should pull any lever that we can to get our national debt under control, and finding interesting ways to limit the growth of our national debt is a noble goal. And maybe some kind of tariff policy should be on the table. Incentivizing domestic manufacturing. Like, I think this is another area where you can look at the negative impacts of globalization. There are many positive impacts of globalization that we can talk about, but the negative impacts of globalization were felt very acutely in the Rust Belt and in places that relied on manufacturing autos or manufacturing furniture. And those jobs that used to be kind of union jobs that were high paying, that provided a degree of kind of the middle class ideal lifestyle for the American worker, may not exist to the same degree because of globalization. And we want to re-incentivize domestic manufacturing. The problem is what you alluded to, which is that it's impossible to get all of those things at the same time. If you bring manufacturing back, you're not going to raise the tax revenue, right? Because you're not importing anything. But if you raise the tax revenue, it means that the manufacturing didn't come back. If you really wanted to isolate China, I think there's an argument to be made that it would have been more prudent to build a coalition of your global trading partners to build the resilient supply chains and the redundant supply chains that can help to replace some of those goods. And then if it's a negotiating tool, that remains to be seen. Maybe we can dig into that whole question a little bit later. But to summarize, I think there's a lot of worthy goals that have been outlined by the administration. I think the question that is being ignored is one that economists ask all the time, which is what are the trade-offs? And what pain are you willing to take to impose the policy that you think is right for the country?
Well, and that's a good segue, because we could, if maybe you're going to be game for this, but you could almost personalize this between the idealistic, perhaps you could say bombastic objectives laid out by Peter Navarro on one side, which lest we forget, he was also involved in raising tariffs in Trump's first administration and isn't necessarily a cabinet member, but I think his title is like senior counselor or something like this on one side, and Scott Bessent the other side. And their mandates are in conflict with one another. And you could say this could end up a fight between these two gentlemen and their influence with President Trump. You might consider a third actor, which is the bond market, which we'll get to as well. But if you just look at Peter Navarro and Scott Bessent, in Peter's case, he's rallying our country to complete the objectives that you just laid out, which at times don't sound very thoughtful, but probably are more than we give it credit. But unfortunately, Treasury Secretary Bessent his sole job is to produce a stable environment to sell debt at a rate that is the most productive possible for not just today's economy, but for the future. I'm wondering what that relationship is like, and to what extent you think one is more equipped to lead us through this than the other, and like, what's that tension like? It must be just thick, to use what David Brooks uses sometimes.
So, I personally, I'm going to have, obviously in my role, I have to read a lot. I have to think a lot. I have to talk to a lot of people, but, I'm not in the White House. I'm not in the administration. I can't give any, additional insight there. I'll speak from the perspective of the markets. How about that? I think that's the safest way to attack this. What the market would love is the Bessent route, right? Like, Scott Bessent is an individual who markets respect. He's a kind of a storied macro hedge fund thinker. But, going back to my trade-offs comment, if the trade-off is, hey, we need to institute tariff policy for some political reason, and the price we're going to pay is instability in the bond market, instability in the stock market, maybe that's a policy choice that the White House is willing to make. It is interesting that we have this kind of like bizarro 21st century like team of rivals in the White House that has all these differing opinions, and they kind of hash it out and hopefully get the country to a better place. But I think the more interesting question is, what parts of the policy platform are going to take priority, right? Like, the administration's come out of the gate strong with the kind of tariff stool of the economic policy agenda. Previously, before the kind of tariff drama started, every time he did an interview, he talked about the importance of getting 10-year treasury rates down, right? And we can talk about why that hasn't happened yet. And the third prong was kind of this idea that a less onerous regulatory environment was going to unleash animal spirits within the economy and lead to a lot of deal flow and M&A activity and corporate earnings growth for businesses. And the sequencing of that has been very mismatched with what Wall Street expected coming into this year, which is why I think you've seen such a strong reaction from financial markets.
Yeah, and lest we miss an opportunity to level set, what is your view on the bond market and the extent to which there are questions about us retaining our reserve currency status and kind of the overall confidence in U.S. assets? And you might want to speak to maybe just how unusual it is when you have a decline in the stock market and a simultaneous decline in the dollar and the bond market and oil. I mean, it's just like, keep going. Maybe even our salaries, for that matter.
Right.
How unusual is that in historical context, and what should we be looking for to give us a sense of a return to health, if you will, as it relates to confidence?
Yeah, it's certainly the topic du jour among Wall Street. Like, I can't go to a client meeting and I can't go to an internal meeting without having this debate and without having this discussion. In the spirit of level setting, there are a lot of really good reasons why the US has been the world's reserve currency. It's, as measured at current current exchange rates, it's the largest economy in the world. It's the most stable economy in the world. It has the largest capital markets. It has the most liquid capital markets. It has the most consistent rule of law, free and fair elections. It has a robust culture of innovation, a robust culture of entrepreneurship, a robust culture of capital formation, a robust culture of shareholder rights and shareholder values. And it has a household sector that has been, the quote unquote consumer of last resort for the world since really World War II ended. And the comparative advantages that the United States has is not in goods manufacturing anymore. It's in services. We have the best financial institutions. We have the best technology firms. We have the best media companies. We have the best, I guess the Europeans could argue with soccer, but we have the best athletes. Like we have Hollywood, we have the movie stars. Like that's the comparative advantage of the United States, right? It's not goods trade. It's not the production of semiconductors, right? Because we've decided that should be outsourced. But that is why the US dollar has been the world's reserve currency, is because finance is one of our comparative advantages. When we measure this, the clearest statistic that shows that the US dollar's reserve currency status isn't going to suddenly disappear is that 90% of foreign exchange transactions involve the dollar. So if you think about every foreign exchange transaction that happens around the world, 90% of them, the dollar's on one side of the trade. When we look at foreign central bank reserves, around 50% of foreign central bank reserves are still held in the dollar. When we look at auctions for treasury securities, we've still seen solid demand from ex-US investors. I think the most interesting statistic that we track, and just a huge shout out to my partner and colleague Joe Seidel, who's one of our economists, helped us think through this, is what are the percentage of trading days where the stock market's selling off, the bond market is selling off, and the currency is selling off at the same time, right? Because that's the dynamic you're describing, which is global investors are losing faith in the United States and they're pulling their capital, right? In the US, over the last 3 years, it's been between 6 to 8% of trading days, okay? In a country like Brazil, it's around 20 to 25% of trading days. You're seeing that activity. And that's a sign that the global marketplace is becoming less, in the eyes of the global marketplace, policymakers are becoming less credible, right? The UK used to be right on top of the US in this metric. 6 to 8% of trading days, you saw UK stocks, UK bonds, and pound sterling selling off at the same time. But after the kind of Liz Truss mini budget disaster, the US and the UK have completely diverged. And the UK is now the second highest country that we track in terms of this metric. So that's what a kind of loss of credibility looks like. The interesting thing is, last week, certainly you saw this price action. I think it was very concerning. And it's one of the reasons why you've seen the administration soften their stance, both in terms of their rhetoric around Fed Chair Powell and in terms of the threats of tariffs. But this year, only 5% of trading days have seen price action where the dollar sells off, treasuries sell off, and the stock market sells off at the same time. So it's actually lower than what it has been over the last 3 years when you just extend your window a little bit. To sum this all up, I think you can think about this, and I think it's prudent for investors to think about this in terms of the absolute advantage that the US has over the rest of the world, which I think is still wide and notable and won't be eroded after a month of what the market views as uncredible policy choices. But at the margin, I think you can make the case as an investor that opportunities outside of the US might be a little bit more appealing relative to the US at this point. But that doesn't erode the kind of absolute advantage that the US has built up over decades.
Well, which would be in conflict with Larry Summers' quote, I think it was last week, when he said the US is devolving into an emerging market type environment or climate. He may have been referring to the weather in this case versus the climate, if we're going to attach ourselves to your argument, which sounds incredibly valid. Another fellow who's been real vocal, who I think we all look up to, is Ray Dalio. And his stuff has been apocalyptic in terms of we're on the precipice of, I think, as he says, something even worse than a depression. You know, I know that you read the same, well, you read a heck of a lot more than I do, but I know you've read this stuff as I have. let's talk about either side of the distribution curve here, either side of the tail. Mm-hmm. Let's go to Ray Dalio for a second. What is he saying that you think is valid, and what do you think is a bit hyperbole? And then let's go to the rosier end of the spectrum and talk about kind of adopting we'll get through this kind of prediction.
Yeah. I don't think I don't think you'll find anyone at JP Morgan, let alone me, who's as dire about the situation the world is facing as Ray Dalio is. And all the respect in the world to Ray Dalio and Bridgewater and how they think about the world and how they invest. But I think their worldview is kind of centered on this idea that we're at the convergence of kind of the end point of this sovereign debt boom, and we're at the end point of this trend towards globalization, and that's going to kind of metastasize into this really painful spiral into both an economic and potentially like hot war that also coincides with the devaluation of sovereign debt and currencies, which I think your analogy or visual of a bell curve is appropriate. I think that's a plausible outcome, but it's not a probable outcome in our view. So that's really extreme. I'd rather spend the time focusing on what like a realistic negative scenario would be. I think that just might be more helpful to kind of calibrate.
I think that's really good. And
people's expectations.
Your CEO has done a really good job, Jamie Dimon, of talking about that maybe left third of the curve with a lot of temperament. And in this case, you can put some meat on the bones, I think, in a really nice way. And then let's also, in fairness, go to the other third, where you see a bulk of outcomes on the positive side, maybe 6 months forward.
Yeah. And, again, I'm thinking as an investor. So, I'm going to kind of avoid the policy discussion we were having before, and I'm going to focus more on like what would be market friendly and what would not. In a negative case, I think there's a realistic case that, we can soften the tariff stance all we want, but the fact of the matter is the effective tariff rate is still going to be close to 15%. Coming into this year, it was 3%, so you're 5x higher. It's going to lead to increased costs for consumers. It's going to lead to a pinch on the consumer wallet, so there's not going to be as much disposable income to spend on non-essential goods. And at the same time, the Federal Reserve isn't going to be able to come in and offset some of the weakness with lower policy rates because the combination of the decline that we've seen in the US dollar and the fiscal package that Congress is currently working on are more than enough to offset the disinflationary impacts of the growth slowdown. So you're in this environment that feels like stagnant at best real GDP growth with close to 4% inflation and rising unemployment, which is a kind of a toxic mix for most financial assets.
What do they call that? Is they call that the misery index when you combine?
They do call that the misery index, and the other word for it is stagflation, right? So when you have
the other word for it is a really bad midterm election for one of the parties.
Yes, that shouldn't be ignored. So if we saw that kind of mix of rising unemployment, rising inflation, and a Fed that puts the Fed in the kind of box where they can't respond effectively to support the economy, I think that's the realistic bear case. So I think that's worth exploring and worth thinking about. And then we have to get into specifics about like where would the stock market trade, where would the bond market trade if that was kind of the case.
Before we assume the Fed couldn't do anything, which is kind of like this debate happening and very publicly last week, is there a scenario where the Fed can add liquidity to the markets without necessarily lowering their base rate or the other levers that they can pull that would improve the functionality of the bond market without lowering the cost of commercial borrowing?
Yeah. I mean, there are, right? Like they can end their roll off of their balance sheet, which is referred to as quantitative tightening. They can stop that. They can. I suppose they could reimpose kind of these special lending facilities that they have in place before lowering the policy rate. But a lot of those, I have a simplistic view on this potentially, but a lot of those measures are signaling. And what they're signaling to the market is like, we're here to backstop financial markets and we're here to backstop the economy. So it puts them in an awkward position when they're kind of like half easing, right? So I don't know if that's the likeliest outcome if we ended up in that kind of like stagflationary scenario that I described.
Okay, that's helpful. Let's go to the other side of the tail view in terms of, I guess we could say, right-hand third of the bell curve, where a bulk of your outcomes are going to lay. Tell us that story.
Yeah, I think it's some combination. And this, again, is like, this isn't the magical, bull case where it's all a negotiation and global tariff rates are going to drop to zero and the S&P 500 should be at 6,500. Like, I don't want to go to that because I think it's kind of magical thinking. But I think that's something like, the effective tariff rate settles in the low teens or maybe 10%. And we have this kind of truce that's struck with China, but a lot of the critical goods to the economy, whether that's electronics or whether that's pharmaceutical or other items, are excluded. And there's kind of enough watering down where, the tariff rate is higher, but we're going to be able to muddle through. And then at the same time, I think there's some truth to the idea that will incentivize a little bit more domestic investment, a little bit more domestic investment within the manufacturing sector that kind of continues the momentum that we've seen in terms of real investment and manufacturing employment. And, the idea that this is like kind of a hard reset to a better stasis is true. I think that's it's a plausible outcome, right? It's just, you can't get there if you do it with market volatility at the levels that we saw over the last couple of weeks. The market needs it to be done in a much more gradual way, right? It's like you gotta, it's the boiling the frog analogy, right? If you put a frog into boiling water, it's going to jump right back out. But if you heat it up slowly, it'll stay in there. I think the market would take it much easier if that was kind of the case. But then again, the U.S. economy has proven to be very resilient, right? In 2022, the narrative was that inflation would never come down. In 2023, it was that a recession was imminent. In 2024, it was that the Fed would never be able to lower interest rates because inflation was sticky. And in 2025, or at least what we're hearing now, is it's over for the US. Policymakers have lost all credibility. Like, we're kind of heading for a recession, and the best investment ideas are, outside of the US. So it should always, like, one of the things maybe to watch is when everyone is kind of shifted to one side of the boat, it becomes more valuable to start focusing on the other side. And if everyone expects everything to keep getting better and to keep going right, it's very valuable to focus on what could go wrong. And when everyone is focused on what could go wrong, it becomes more valuable to start focusing on what could go right.
Larry Fink has said that we're already in a recession, which I think he meant to be provocative. I'm not sure he meant that technically. What would you say to counter that argument?
I don't think so. I mean, the stock market's down, call it, depending on, when this podcast goes out. I don't want to put a specific number on it. I just realized there's a little bit of delay there. But let's say the stock market's down 15% from its peak. Okay, that's a drawdown that we see once every 12 to 18 months. Okay, no matter what the reason is. Stock market goes down 15% from its peak every 12 to 18 months. High yield credit spreads, which is another indicator, you mentioned this, is another indicator that I think the business community would be well served to watch. High yield credit spreads are around 400 over treasuries, which is much wider than they were at the beginning of the year, but it's not at a level that would indicate recession, which is much more like 600 to 800. Businesses are citing uncertainty as a reason to kind of pull in their horns and not go through with some of the spending plans, but that's more of a sentiment data point and not a hard data point. We haven't seen that come through in the kind of real-time jobs data, the real-time hiring data, the real-time spending data. And if anything, it seems like we're getting a little boost to consumption because everyone's worried that prices are going to go up. So I think that could lead to like supply chain issues and maybe a give back later. But, I think you made this comment earlier, forget toilet paper. Like, I'm sure there's a lot of families who are saying, we've had our eye on that BMW. We've had our eye on that Lexus. Like, should we get it now before the prices start to rise because of auto tariffs?
Well, so we'll sacrifice our toilet paper for a BMW.
Yeah, exactly. And I think that also is a good, not to go all the way back to the beginning, but I think that's also a good comparative between the COVID crisis and this episode. This episode is certainly important and it might have implications for the next couple of decades. but I don't think it's as intense or as frightening or apocalyptic as the COVID episode was.
I think in this case, maybe to underline your point that you just made, is that how quickly we forget that we weren't in control of that one.
Yes.
I mean, we didn't have a vaccine, right? We didn't know.
Well, you remember at the beginning, we didn't even know if you should wear masks or not. We were like, should you do that or not? No one knows. That's the huge difference. It was completely out of our control broadly. And this episode, and this is also important to note, it's being driven by the executive branch. And if there's another angle that I think will require more and more attention from the investment community, it's like, how are the reciprocal tariffs going to do when they face legal challenges? Because there are going to be legal challenges against the reciprocal tariffs and the kind of Liberation Day ceremony, just because they're being effectuated using, a law from 1977 that has never been used to levy duties before. So there's a lot of twists and turns that this episode could take, even outside of what direction the administration wants to take at a given moment.
Yeah, I've wondered, you mentioned quantitative tightening, and I remember this expression, a taper tantrum.
Yeah. The original taper tantrum was Ben Bernanke.
Wow. How quickly we forget.
Blast from the past.
In this case, you could call it a tariff tantrum if we want to have a optimistic view that in the future, we'll look back at this moment as being akin to a tantrum of some kind, and that the institutions, the bond market, basic economic conditions course correct what might have been a little bit of impulsive policy initiation. And we just sort of shrug our shoulders and say, boy, that was kind of weird. I would say in the meantime, sitting where I sit and where you sit, investment activity is tough to predict. There's so many risks in what we do anyway. You throw this on top of it, a lot of people in the private equity and industry and in corporate America are wondering where they should make their bets, or if they should make their bets at all. And I wonder what the lag effect of that will be. I do wonder whether we have impaired kind of the trust of the international community insofar as our reserve currency and what pulling back and putting that all together would look like. But at the end of the day, you've given us such good evidence that things will probably be all right from the sounds of it. What advice would you give people who are making these investment decisions, Jake? And what should we be looking for as it relates to policy voices that you think, or outside influences to the current administration that you think could be a harbinger of a more benign outcome here, or maybe one that's even worse?
Yeah. I mentioned before, we're working on our mid-year outlook. I'll plug it. You didn't ask me to, but I will. It comes out May 19th. So if you want to hear the latest thoughts,
I just feel bad for whoever's editing that sucker, because every day I would be tempted to take an eraser. I hope you did it.
You're looking at the person. Huh? You're looking at him. That's my.
Did you write it in pencil?
Yeah, I mean, it's the whole marketing department is angry with me because I'm supposed to have a draft locked by Friday, and I'm gonna have to tell them that's gonna be impossible. But in the mid-year outlook, this theme that we're coalescing around is being comfortably uncomfortable. And I'm stealing that line from my man, Matt Wilpers, who's my favorite spin instructor on my bike at home. And, it's this idea that like when you feel yourself getting uncomfortable, and I don't think there's any question that a lot of business owners, a lot of investors are feeling uncomfortable about the uncertainty, feeling uncomfortable about the volatility, you have to take steps to make yourself feel more comfortable in that environment. And from an investment portfolio perspective, it might be taking a look at your plan, making sure your asset allocation is in the right place, making sure you have your spending needs locked up, making sure you have the right volatility, making sure you have the right amount of risk. Maybe it's a position for you to add to equities because you have a long-term plan and adding on the dips has tended to pay off over time. Maybe you need to reduce risk a little bit into places like private credit, into fixed income, into equity-linked structured notes, into places like gold, because you don't feel like you can carry that amount of risk. Another way we're thinking about it as investors is, what do we feel more certain about? Like where are those kernels of certainty no matter where tariffs go? And one of those areas for us is artificial intelligence, right? Like if anything, the news of this year has made us feel like AI is we're more confident that it's going to lead to productivity gains for the economy and businesses. And it's because the technological improvements have been exponential and the cost declines have been staggering, right? So we're down the top tier model that scores an 85 or 90 on the GPQA diamond test, which is, how you measure kind of human intelligence. We're down 80% from where we were in 2023 in terms of cost, right? And you can get a less expensive model that's down 99% and even shows performance improvements. So when you have that dynamic, it's akin to whether it's the Bessemer steel process or the invention of the ATM or kind of air travel, where you have a reduction in cost that leads to a vast improvement in adoption and use and engagement. And we think we're on the cusp of that for AI. At JP Morgan, I'll brag about JP Morgan a little bit. We think we've been in the lead with this trend in terms of implementing AI solutions and AI technology into our business. And the use cases are becoming very clear. The productivity gains are becoming very clear. And that's going to continue no matter where the effective tariff rate ends. So between taking actions to make yourself comfortable being uncomfortable, focusing on things that you feel certain about or things that I think are two strategies that you can take to help manage through this volatility. And for business owners, I think it's applicable. I spoke about it in more of an investing context, but if you think about your kind of business that you manage as your portfolio, I think there's a lot of analogies to draw.
Well, and if you get to plug your mid-year report, I get to plug one of our portfolio companies called Nimble Gravity that turns all that AI imagination into reality. And they are growing like a weed and creating success stories all over the place as it relates to AI's potential. And it's really cool that you're suggesting kind of a different way of looking at this crisis insofar as looking around the corner and looking for opportunities while everybody else is, in the fetal position. And boy, what great advice for all of us. Because I think we can get to go back to the beginning of this podcast. We get sucked into the news and we get cranky and pessimistic, and all of a sudden our creativity goes down and our risk taking becomes irrationally conservative. So, that's a lot to think about, and I appreciate, Jake, you challenging us business leaders to think differently about this. And thank you for being here. I had no idea whether you would even take the request. And it means a lot to me and to our firm and to our community that you've invested this hour of a very busy schedule in high demand work that you're doing right now to support our ambitions. And Jake Manoukian, thank you. Skier, research expert, banker. You can't see him on the screen. Great looking guy.
Oh, wow.
Father,
that's so flattering. Well, I'm bright red now. You can't see me, but I'm bright red. The pleasure was all mine, all ours at JP Morgan. We're glad we can help you. We're glad we can help your mission, and happy to come back maybe when this is all sorted out and we can do a recap.
Thank you, Jake, and appreciate everything that you guys do at JP Morgan. It's a extraordinary organization, and we're very grateful.
Thank you again.